Sorry guys, I couldn't wait. I couldn't wait to crack the can open. Had to get into that lemonade. But hey, guys, happy Friday. Welcome back to another Dividend Happy Hour. We got the camera working again this week. If you were here last week, I was up in arms because this camera wasn't working. And I said, watch, as soon as I get off the stream, I'm going to try it again and it's going to work perfectly. And sure enough, that's exactly how it went. No idea. But anyway, guys, I am so happy to be back with you guys for another live stream. I hope everyone had a fantastic week. I don't know about you guys, but I'm closed a little bit in the red today. Nothing too crazy. I think overall it was mostly a red week for me. And I'd be curious to hear what was going down in your guys' portfolio this week. But guys, before we get into anything else, before I keep rambling on, why don't we kick this thing off the best way we know how? So grab whatever it is you're sipping on. Personally speaking, I got a little Minute Maid Zero, a little lemonade. So anyway, grab whatever it is you're sipping on and let's do a cheers. Here's to you guys. Thank you so much for tuning in to episode 115 of the Dividend Happy Hour. This is going to be the highlight of my week. I was really looking forward to this today, as I do every week. But here's to that. Here's to you guys. And also here's to the dividends and the pursuit of that sweet, sweet cash flow. Because that's really what's bringing us together tonight. But anyway, cheers. And let me know a few things here in the live chat, my friends, or in the comments below if you're watching the replay. Number one, I want to know what you bought this week. Which stocks did you add to your portfolio? We're starting to get to the point where, some more attractive deals are starting to pop up. I feel like these last couple of months, they were pretty scarce, but we're starting to see a little bit more action there. So let me know what you picked up this week. I'd be curious to know. Number two, what are you sipping on tonight? What did you bring to drink to the Dividend Happy Hour? I already know Shamir's got his Coke Zero. I already know Chris probably has his Ghost something or other. Someone out there has their Woodford Reserve. But yeah, let me know what you guys are sipping on tonight. And number three, what else we got? Number three, did anything cool happen in your guys' portfolio this week? Did you hit any dividend income milestones? Maybe some of you guys are at all-time highs in your portfolio. Maybe you bought your 100th share of Realty Income, or maybe you just added a new position to your portfolio. Did anything cool that happened to you guys? I want to hear about it here in the live chat or in the comments below. And also number four, let me know. There's 93 of us here in the stream right now, which, by the way, if you haven't already, hit the thumbs up button on the stream one time. But there's 97 of us now. Let us know here in the chat if this is your first time tuning in to the Dividend Happy Hour. I want to know how many first timers we got here. And in case this is your first time, just so you know, we do this live stream every Friday night starting at 5 p.m. Pacific time, 8 p.m. Eastern time. So it's kind of the weekly ritual, good way to end the week, head into the weekend. So, but yeah, I'm looking forward to getting into it with you guys. And once again, I'm so stoked to see everyone. Let me scroll up to the very tippy top here of the chat. And just shout out all of you guys who are tuning in. The first comment I see here is from Big Bad Jim Betts. What's up, Jim? Looks like you went on a nice little shopping spree this week. Sold Mondelez and picked up, looks like 5 different companies. Nice. We got Joey here. Vacation Time 247 is here. Of course, we got Shamir. And Shannon is here as well. What's up, Shannon? Mike's here. Chris is here. Fast Eddie. Rye, the investor guy. We got all the usual suspects in the building. We got Pat, who says he almost forgot. You know what? I don't believe that, Pat. You're pretty on it. But happy to see you, my friend, either way. Striper Kid's here. We got Sharias. Sharias? I think I'm close there. Sharias. I'm going to go with final answer. Let me know in the chat. Help me with this pronunciation. Correct me a little bit. Sharias. That's what I'm going with. Okay. But yeah, let me know how to pronounce it so I get it right. Coyote's here. Run DMS is here. Lucas, what's going on? Yeah, nice hoodie. Shout out Blossom. Guys, if you haven't already downloaded Blossom, definitely check it out. There's a link to Blossom in the description of the video. It is the first, and as far as I know, the only social media platform specifically for investors. It's a lot like Twitter, kind of like Instagram, but once again, specifically for investors. There's a portfolio tracking feature in there as well that's pretty nifty, and just a really great community. I think they're getting close to hitting 200,000 investors on the platform, and I definitely think you should be a part of that. It's a really cool place to be. So once again, link in the description to check out Blossom. It's free to download, and if you guys do download it, shoot me a follow on there. I'm pretty easy to find. just search Ryan and I'll pop up there. So, but yeah, Lucas, to answer your question, man, it is getting very cold here in Vegas. And it flipped just like a switch. It was like, last weekend, we were in the highs of probably like upper 70s, low 80s. And then pretty much overnight, I'm not even exaggerating, overnight it went from that to the highs being in like the mid 60s and the lows being in like the 40s. So it's really feeling like winter right now. But I'm ready for it. I was ready to bust out the long sleeves. I love wearing just like fall and winter clothes. So I was happy for it. But yeah, it's chilly here. So, okay, we got Ricardo's a first timer. Welcome, Ricardo. Happy to see you, man. Oh, first time live this month. There you go. I get it. Good stuff. And happy November, my friends, on that note. A new month, second to last month of the year. Let's make it a good one. Can't believe it's already November. Let's see. Craig's here. SCHD Stan, what is going on? Buying his two favorites here, whichever is more red. There you go. Bernard's here. What's going on? Happy to see you. Dimitri is in the building as well. Yeah. So I put out a community post on this a little bit earlier this afternoon. I'll just reiterate that here. So, and I know you guys have seen this before. Definitely here on YouTube in the comment section. It's pretty ripe with scammers. Not just me. Like if you go to any creator's channel, you go to Nolan's channel, you go to really any YouTube channel, there's pretty much always going to be, you'll always find some people trying to impersonate those creators. You always see the scammers and spammers, and it doesn't just happen on YouTube. For me, it happens in the Discord group. It happens on Blossom. It happens on Instagram. It happens pretty much everywhere. And now it's happening via email. They're actually creating fake emails. Like someone actually shout out Colby over at the DGI Crab, who actually just had, I was watching it. I just finished the video right before we went live. Really good video with Ari Gutman on the Masters in the Market series. I highly recommend you guys check that out. Check out Colby's channel at the DGI Crab. But he emailed me just letting me know that someone had made an email that's retire@ryan@gmail.com, just pretending to be me and doing exactly what Vacation Time here is saying. And so long story short, I just want to reiterate, if someone's reaching out to you, and it looks like me, if it's like a cold message, just a random message or a random email or a random DM from someone that looks like me, chances are it's probably not me. And if you have any doubts, or if you want to just double check that, you can always shoot me an email. My real email is ryan@retirewithryan.com. So feel free to always reach out to me via email. On Instagram, my handle there is @retirewithryan. You can leave a comment on a YouTube video, any which way you want to get a hold of me, just to double check. Please do so, because I would hate for you guys to fall victim to some scam. And a lot of you guys, I mean, you guys know me well enough. I'm not going to crypto. Come on, that should give it away right there. But anyway, Vacation Time. Thanks for bringing that up. Anyway, let's keep going here. I see Rookie Trades in the building, in no way affiliated. What's going on, man? Renzo's here. What's up, Renzo? Let's see. There we go. That's funny. That is funny. Good stuff. Let's see. Ryan is here. Second time in the stream. Good to see you, man. Sir Dude Bro Man. What's going on, my friend? Oh, Shamir, happy to help, man. Happy to help you. Let's see. Real Madrid. Your stream keeps freezing and cutting off. Is anyone else having this issue? It might be just on your end, my friend. It might be an internet connection issue. But yeah, guys, let me know. My internet's pretty juicy. So I with all due respect, I don't know if it's me. But yeah, let me know if you guys are having the same issue for whatever reason, because I could be wrong. Patek's here. What's up, Patek? Korean Cardboard. What is going on? Oh yeah, Colby's here. DGI Crab. Nice shopping spree here too. Definitely some discounts in here. Hershey's at their 52-week low. Nike's they're pretty much at their 52-week low, I think. Talked about them in Wednesday's video. Yeah, and then Archer Daniels Midland. Yeah, they've been going down too. I haven't been keeping close tabs on Target, but Dividend King, gotta love that. So, and Colby, just let me say once again, man, really good interview with or I don't even want to call it an interview. Really good conversation with Ari. I really enjoyed that. So, and I'll be sharing that in my newsletter next week. So let's see, Ruslan. Hopefully, I pronounced that right. Went in on went in 15 on VU in Microsoft. Okay, nice. Oh, 15K. Holy cow. Dude, that's good job. Good stuff. Ooh, Renzo's drinking a Sam Adams. That sounds good. I've had a few stouts this week. Bought some at Trader Joe's. Really good. Just bought like a 6-pack and had a couple of them these last few nights, and that was really nice. I missed having stouts. And it's that time of year for it. It's getting to be that time of year where stouts are exceptionally delicious. I like them year round. A lot of people don't like stouts in general. A lot of people especially don't like them during the summer. I will drink a stout 365 days out of the year. I love it. Oh, this is cool, Ryan. Nice. Holy cow. Crossed $47,000 in projected annual income, my friend. Good job. Almost at 4K per month on average. That's great. Sipping on that yak, a little cognac. Nice. What do you got there? A little Hennessy, or what are you sipping on there? Striper Kid with a Tito's and Monster. Wow, that is a dangerous combination. Holy cow. Holy cow. Shamir actually made a purchase this week. Just bought S&P 500 index fund. There you go. Through the employer match. Way to take advantage of that. Mike definitely juiced his income up this week. 10 shares of Blue Owl. Nice. And 5 shares of Devo. Good job. Oh, Eduardo. Nice, my friend. SCHD, Amazon, and Occidental Petroleum. And sipping a little Irish whiskey. That sounds so good. Oh, man. Wow, JJ. Nice pickup. 60 shares of SCHD. Good stuff. And then Kevin with the milestone, big 100 shares. Good job, man. That's great. Where am I at, guys? Sorry for getting distracted real quick. Do this. There we go. I like that view better. I've been liking that view. So this is my dividend portfolio tracking spreadsheet, which, as you guys know, if you want to check this out and download this spreadsheet, there's a link to it in the description. So right now, as of this week, I'm at basically 296 shares of SCHD, and my goal by the end of the year is 300. Guys, we're going to get there probably in the next 2 weeks. That's my guess. Next 2 weeks, maybe 3 weeks, but yeah, we'll definitely be there. Another thing, guys, we are less than $15 away from hitting $3,000 in projected annual income, which will break down to $250 on average per month. We'll definitely get there in November as well. So that'll be 2 of my goals for the year checked off a little bit early. So I'm happy to see that. There we go. Chris with a few big purchases: SCHD, Apple, Realty Income, VU, and NVIDIA. Okay. Nice. Looks like Sky, a little similar there. NVIDIA, Microsoft, and Apple. And then Renzo, this is your first time in the stream. Well, welcome, my friend. I hope you enjoy this. And also, too, I didn't mention this earlier. We'll usually run the stream for about an hour. Typically, it goes at least like a few minutes over. But yeah, that's pretty much how it goes. And as you can tell, there's really no rhyme or reason for it. We just kind of come and hang out and talk stocks and see where it goes. And it's different every week. It's a lot of fun. I like to think of it as just, exactly what the name says. It's a happy hour. We're just coming to hang out. And I don't know about you guys, but it makes me happy to talk about dividend stocks for an hour with you all. So I think the name's fitting. Let's see. Where am I? I think okay. I was a little bit behind in the chat. I was about 10 minutes behind, and then it jumped me forward. Also, Dimitri's first time in the stream. Welcome. Welcome, welcome. Let's see. Yeah, man. Picked up some UPS. Nice. Oh, and Caesar. Hola. ¿Qué tal? ¿Cómo estás? Let's see. What else we got? Ooh, NA hit 100 shares of SHD. Nice. Very nice. Very nice. Oh, Jim, this is a great question, asking about Blossom's desktop application. Not yet, but I actually was talking to Brandon Beavis, who's one of the co-founders of Blossom, and he gave me a little preview of the desktop application that they're working on. So I think in the next couple of months or the next few months, he didn't give me a timeline exactly. This is just my speculation, but I would imagine that they'll have that rolled out in the next couple of months or the next few months. So that is on the way. I've seen some glimpses of it. It looks really good. And I'm very much looking forward to that as well. So yeah, it's coming. But for now, it's only an app. And unfortunately, it's only available for investors in Canada and the United States. Unfortunately, they're not over in Europe or Asia or anywhere else yet. So I apologize for that, my friends. Let's see. Keep going. Okay, I'm still 10 minutes behind in the chat. I'm gonna try and catch up here real quick. This is cool though. Arjani, congrats on the 25K milestone in the portfolio. And nice buys this week too. Like there's not a bad stock in the bunch there. So good job. Striper Kid with some nice buys as well. Excuse me. ASML looking good. Talked about that one a couple days ago. SHD, obviously. And then EPD. Love that. Very nice. Oh, gosh, that is so good. You guys know I love my Fresca, but sometimes lemonade, you just can't beat it. Okay. Okay, cool. Sharias. Cool. Got it. Sky wants to know, is Vici a buy right now? You know, my quick thought is no. I mean, it could be. It's really not bad. I mean, if we look at the share price on Vici, quick answer turned into not so quick answer. You know, if we look at the share price right now, what's it at? It's at 31. You know, yeah, I don't think that's bad, actually. I don't think that's a terrible price. I mean, recently we've seen it as high as, I think, about 33, maybe so. But yeah, it's not a terrible buy. I mean, if it depends. No, it doesn't really depend. I think it's fine. You'll be fine buying it now. The good thing about Vici, even at its current price, it still has a dividend yield of 5.4%. So you're still able to lock in a pretty solid cash flow return. Definitely not going to complain about a 5.4% yield. So yeah, I don't think Vici's a bad buy right now. I was really stoked and very fortunate to get it at this price right here, $28. But even, you know, who's to say when it'll get back to that point? So yeah, I don't think it's a bad buy right now. Could be a lot worse for sure. And then Mustafa, same question pretty much. There you go. Okay, so B, great question. I'm going to save this one. We're going to circle back to it in just a few moments. I do have some thoughts on AGNC that I would love to share with you, and yeah, and we'll check it out in just a moment. So, okay, Matt, driving cross country. Nice, my friend. Have a safe drive. Be safe out there. Let's see. Yeah, Joey, this is a good question too, talking about the goal with SCHD. Yeah, so my initial goal pre-split was 100 shares, and I've adjusted my goal for the split. So now by the end of the year, the goal is 300 shares for sure. So, how do you feel about leveraged ETFs? I don't really know what they are. I'm going to say my knee-jerk reaction is to say probably stay away from them. It's just that's my thought with most investment products. I mean ETFs are investment products, but like normal ETFs like VU and SCHD, but I think those are going to be so much more straightforward than something like a leveraged ETF. Those are going to be so much more straightforward than like a covered call ETF. And my thought with those types of things, whether it's leveraged ETFs or covered call ETFs or synthetic covered call ETFs or, you know, anything kind of in that similar category and adjacent, I just think you're going to be chasing your tail with a lot of those. I think it's going to be impossible to keep up with all the new investment products coming out. I think you will be tempted. If you buy one of them, you're going to be tempted to buy the next thing that comes out. And the thing is, they keep trying to up the ante. You know, first it was covered call ETFs. Now these synthetic covered call ETFs kick it up a notch. That wasn't good enough with them paying monthly dividends. So now they have to pay weekly dividends. And it's just a never ending, you know, ante upping thing. And I just think It's too much to keep up with, and most of it's not worth it in the long run anyway. So I just for the sake of simplicity, I don't even pay attention to that stuff. I completely stay away from it. It's not in my interest at all. Okay, Salvatore wants us to take a look at AMD. We'll take a look at the financials on Snapstock in just a moment, even though it's not a dividend stock. Sure, we'll take a look at it. No problem. So, okay, we're getting caught up here in the chat. Botan, welcome, my friend from Hungary. Cool, very cool. Yeah, I haven't talked to Russ about doing a stream together. I actually need to text him back. I'll ask him when I text him back. I'll ask him if he's around next week, and if he is, then yeah, I'd love to chat with Russ. It's been too long. We pretty much always text at least, and we'll send voice messages like back and forth. But yeah, if he's around, if he's available next week, I'll see if if he'd be interested in coming on. That'd be fun. Ooh, would be curious to get your thoughts on CME. I actually have looked at this company before. We'll take a look at it again. I remember liking it. So yeah, I'll save that comment and we'll come back to it. Thank you for the question too, or the suggestion. Okay, so this is great, Renzo. This is great. We're gonna talk about this too. We got some good topics tonight, guys. Let's see. You hit big on a 5% moonshot. Okay, we're gonna come back to this one too. I need to give that some thought. This is a good question. Super quick one to answer. So Coca-Cola, they basically KO, ticker symbol KO. They basically they have the formula, they make the syrup, they then sell that to places, and they also sell the can. Coke, COKE, is the distributor. So they're the one who ships all the products and distributes it wherever it needs to go. Hopefully that makes sense. Let's see. Do you own any pharmaceutical stocks? Yeah, I have Johnson & Johnson and AbbVie, who AbbVie had a killer week this week. Let's see. Okay. This is a good question too from Trista about REITs. We're going to come back to that. And it looks like I'm caught up in the chat here. So let's go through all of these questions that I have saved, starting with this one here from B, who wants to know thoughts on AGNC. Okay. So pretty much my overarching thought on AGNC, I think AGNC is a mortgage REIT, right? It's an M REIT. Let me just double check that. And maybe we even looked at it last week or a couple weeks ago. I don't remember. I feel like we talk about this one somewhat often. So yeah, AGNC is a mortgage REIT, and I don't think it's worth investing in. And I'll show you why. Long story short, I think it's a pretty big yield trap. And I'll show you over here on Snapstock, which you guys can also start using. There's a link to that in the description as well. I think AGNC is a big fat yield trap, and it's very easy to find these. So if we scroll all the way down, okay. So first and foremost, I don't know why it's not loading the dividend stats. We'll pull them up here on Seeking Alpha real quick. So here we can see that AGNC has a 15.5% yield, and I'm sure you're looking at that, being very tempted by it, thinking, invest $100, I can get $15.5 back in dividends. That's pretty great. But this right here should turn you off of, like, I don't even care what the yield is. It could be 93.67% for all I care. And I think this would be this would immediately turn me off of that. And it should show the dividend history here. And this is exactly why. If you come across a stock, once again, I don't care how high the yield is. If you come across a stock with a dividend history like this, just run as far away as you can from it. Okay. This is the opposite of what you want. Okay. AGNC has a history of reducing their dividend payments over time. They're no stranger to cutting their dividends. And when you see a chart like this, really no matter when you buy it, whether it's today or whether it was 10 years ago, the general trend is that you're going to be losing money on it over time. Your cash flow return with this company is going to be going down. And I think we go back over here to Seeking Alpha and go over to the dividend yield chart. It'll give us a good picture, I think. No, yield on cost. That's what I want. No, actually, yes, actually, it will. So if you would have bought 10 years ago, your yield on cost today would be 6.39%. The current dividend yield is 15 point something percent. Okay. So your yield on cost today would be less than half of what the dividend yield would be, the starting yield would be today. And as we can see, the more we reduce the time horizon, the higher the yield on cost gets. Typically, it's the opposite. Like if we go to look at something like Lowe's, the longer that we zoom out, the longer the time horizon, the higher the yield on cost. So it's the exact opposite of something like Lowe's. You can see that right here, right? So, by today, you're getting a less than 2% yield. 10 years ago, if you would have bought 10 years ago, those same shares would now have an 8% yield on cost. It's going up over time. And so long story short, you don't want to buy any investment. It doesn't matter how high the yield is. You don't want to buy any investment that's going to basically reduce your income over time. That's like just antithetical to the whole concept of dividend investing and building a dividend snowball. So it's tempting to get wrapped up in those high yields, but it's at the end of the day, and from a long-term perspective, it's really not worth it. It actually does you more harm than good. And that's not to say that high yielding stocks are bad, but ones that have dividend history charts where it's going down over time, those are bad, objectively bad, and you should stay away from them. So hopefully that makes sense. If you have any follow-up questions on that, I'd be happy to check them out or to try and answer them for you. So, but anyway, moving on to this next question from Salvatore. Can we take a look at AMD? Yeah, we'll take a quick look at it, see what's going on with the financials. AMD, what is this? Advanced Micro Devices. What's AMD been up to this year? Decent year. Not really, actually. I mean, okay, big drop in the last month. 26.4% in the last year. That's okay. It's funny, like that one's up 26%. Altria is up over 30% in this, actually over 40% in the same time period. It's just it's funny how share prices work sometimes. Free cash flow yield is very low. Okay, free cash flow yield is very low. So maybe they're not doing too hot with the free cash flow. Yeah. So it's kind of interesting. It's very interesting. The revenue chart looks great. Revenue chart looks really good, straight up and to the right for the most part. Earnings per share it hasn't been bad either. Like they weren't profitable about 10 years ago. Then they, became profitable. Earnings soared in 2020 and 2021 and then dipped back down. I don't think, especially if we take these 2 years out, for whatever reason, these were anomaly years for earnings and for free cash flow per share. If we take these out, I would say that the general trend on the earnings per share and the free cash flow per share looks pretty good. It's growing. So I don't think that's too bad. The margins look pretty good too. Like the gross margins have really expanded. This is great. The net profit margin's a bit spotty. These were good years here, but overall it's like mid-single digit net profit margin. Not that that's good or bad. I'm just thinking out loud as I'm noticing that. Looks like the free cash flow margin actually some years is maybe higher or similar. Nah, not higher, but similar. So I would like to see more consistency in the margins, and maybe that will come with time. No debt. That's good. That's a really good sign, right? Love a company with no debt and no dividend. So, and they're issuing a lot of shares, but this company just became profitable. They're still probably in the younger years of their corporate life cycle. So this probably isn't too surprising. So I think there's some good and some bad here with AMD. I would say that anything beyond what I've said is going to be out of my wheelhouse. I don't really know how to look at it beyond this point, and I don't know enough about the company to really give it a better analysis beyond just saying, "Oh yeah, revenue's good, earnings is okay, free cash flow is okay, margins are good." So yeah, there's some good and there's some bad, but from here, if I was you, I would think about what are some of the qualitative aspects of the company, and some of the tailwinds that it has that could continue driving this revenue growth and hopefully earnings growth and free cash flow growth. Um, Profitability is heading in the right direction, so hopefully that will continue. But yeah, I think there's some good and it's not all bad. I guess that would be the same thing as it being good, right? So anyway, hopefully that was somewhat helpful. So let me jump back over before we move on to the next question. Let me let me I got a request here for Evolution AB. Would you tell me the ticker symbol, Nino? We'll check it out. We'll try and check it out. I just want to get caught up in the chat here real quick before we move on to the next question. Eduardo, yeah, well, let me just answer this one real quick. It can't, I mean, there's no predicting the future, obviously, but it can, I think based on SEHD's criteria, so far they've done a really good job of selecting companies that when you put them all together will result in a dividend growth rate that is certainly greater than 6%, over 10% so far. So I think they've done a good job of it. It's hard to say if that's going to be able to continue for the next 20 to 30 years, but at this point in time, I and maybe Craig can speak on this a little bit more than I can, but at this point in time, I have no reason to believe that it won't be able to at least hit 6%. I think that's a pretty doable feat. 6% is, yeah, I think that should be pretty doable. But it's obviously not a guarantee, so let me say that. Then I got a great question here from Mustafa, so I'm going to save that on valuing stocks. Let me see what else we got here. Got here in the chat. I see a question about VIG. Just quick note, I do like VIG. I think it's a solid ETF. Okay, ticker symbol EVO for Evolution AB. Cool, thank you. Okay, so we're going to jump back over here and take a look at CME, Monopoly on Futures Trading. Okay. So yeah, I remember briefly looking into this company and really liking what I saw in the financials, if it's the same one that I'm thinking of. So as we can see here, let me see if I can make this a little bit bigger, guys. Let me see. Just a tiny bit bigger. Okay. I don't know why it is not loading. Is it going to work for Visa? Yeah, so some companies it's working. Some of them it's been kind of funky. Okay, there's a dividend structure there. Yeah. I don't know what sounds I'm making right now, so just disregard disregard me. So we'll take a look some of it on Snapstock, some of it on Seeking Alpha. Okay, so looks like they'd had a really good year looking at share price. This is great. Revenue straight up and to the right, earnings per share straight up and to the right, and I think if we go look at the free cash flow per share, it's going to show a similar trend. Free cash flow per share straight up and to the right. So all of that looks very promising. Margins high and steady. Gross margins, we're looking at about 80%. The net income margin looks to be going up over the years. It's gone from 36, upper 30% range to now being in the upper 50s. So that's a really solid improvement. And the same is true here with the free cash flow margin. It's gone from low or mid 30s to now close to 60%. So I think so far, like 3 stars, 5 stars, 2 thumbs up. A lot of brownie points for me for CME so far. Debt situation looks really good. Looks like they have more free cash flow per share coming in than they do net debt. So that's great. For every dollar of free cash flow they only have 30 cents of debt. So that's basically not an issue for them at all. Clearly a solid dividend growth stock. Looks like they reduced their dividend between 2017 and 2018, but it was just a blip, over time. That dividend growth slope is hefty. The 5-year and 10-year growth rates are both double digits, looking really good. Looks like the last couple of years, last 2 years, 2022 and 2023, were really solid growth years for the dividend. So that's great. One thing, if this is correct, one thing that is concerning is this right here, the free cash flow payout ratio being over 100%. I want to go consult Seeking Alpha and see if I can get a little more clarity on that. If it'll tell us the free cash flow, it doesn't tell us the free cash flow payout ratio, unfortunately, but we can manually look this up. So, okay, going over to the cash flow statements, free cash flow per share. Let's just do 2023, $9.41. Okay, going to the dividend per share, 455. So this is tripping. It's tripping right now. So it looks like the free cash flow payout ratio is really more like less than 50%. But this is interesting too. It says the payout ratio is consistently above 100%. So, but that's not even right either. So, because look at this, guys. So, earnings per share in 2023, 887, dividend per share 440. So the earnings payout ratio is really 50%. So something's wonky here. Something is not quite right with how they're reporting this, and I'm not sure exactly what, but it doesn't look like the payout ratio is any cause for concern. So yeah, I think CME looks pretty solid. You said they have a monopoly on futures trading. So, that could be a pretty solid competitive advantage. No debt. That's great. So yeah, I think it's looking pretty good. Okay. So Renzo, this is a great question. So I have a bunch of stocks. Excuse me. Sorry, guys. I make so many weird sounds. Okay. I have a bunch of stocks, but still ignorant to the inner workings like dividends. Basically not even sure what that means. So a dividend is essentially a portion of a company's leftover profits, leftover cash at the end of the day that it can use to. Let me actually take a step back, okay? Companies, they sell products, they sell services, and from that they generate sales. They bring in revenue. It's called the top line. Okay? And let me see if I can paint a picture here. That's this right here. They bring in revenue from selling their products and services. Well, in a lot of cases, it costs them money to, pretty much in all cases, it costs them some money to make those products or to deliver those services, okay? And that's where all these expenses coming in, your operating expenses. You've got taxes, you've got to pay your employees, you've got marketing, you've got, physical locations, warehouses, you've got all these different things you have to pay for. And at the end of the day, when you take care of all of that stuff, what's left over after accounting for everything, literally everything, is free cash flow. It's cash. It's basically the extra money that you have left over that you can do a handful of things with. With this free cash flow, a company can, they can pay down their debt if they have debt. They can, and it's not really different to you in your personal situation. You have a job, you generate income, you have to pay your rent or your mortgage, you have to pay for groceries, you have to buy a new pair of Vans, you have to go to the movies, you have to maybe get a Starbucks here and there. You have all these things you have to pay for throughout the month, and hopefully you've budgeted things correctly to where at the end of all of that you have some money left over. Hopefully you've got a surplus of cash that you can use to do a handful of things. You can keep it in your bank account. You can maybe pay down your credit card payment. You can give some to your wife. You can, you can do you can invest it. You can do all these different things with that leftover cash, that surplus of cash. The same thing pretty much applies to businesses. With that leftover cash, with that free cash flow, they can pay down debt. They can just save it in the bank, save some rainy day money, which they can then use to make acquisitions or just, build a fortress balance sheet, just rainy day money for potential, things that can happen in the future, emergency money, whatever. Or they can pay out a dividend, which is, basically the cash they're giving you just for being a shareholder. It's a percentage of their earnings that they're not using for these other things. They have no other better use for it, hopefully. And so they decide, you know what, we're going to reward our shareholders. We're going to give them a paycheck. And in a nutshell, that's what a dividend is. It's just a paycheck that you're getting from the companies that you own, that is representative of the leftover profits and free cash flow that they have after taking care of all of the money that it takes to maintain their operations and grow the business. Hopefully that was kind of a lot there. So hopefully all of that makes sense. Um, and when it comes to stocks, I think it's important to touch on this too. A lot of people think of stocks. You might not, saying you're still ignorant to a lot of the inner workings of this stuff. A lot of people don't even know what a stock is. In a nutshell, a stock, as you probably could have gathered from just contextually from how I was just my gibberish and explaining all of that, a stock is a sliver of ownership of the business. So let's say we have Coca-Cola. By owning one share of Coca-Cola, by definition, you are an owner of that business. That business is publicly traded. It has thousands and thousands of owners. And anyone who buys a share of Coca-Cola is taking part in ownership of the business and has a right to benefit from its growth and its success. And that's kind of what a dividend is. It's a little, just a little hat tip. Thanks for giving us your money. Here's some of it to, we've done pretty well with it. And here's some extra that you can have, from the dividend. So hopefully that makes sense. I wanted to stop before I went on another tangent there. So anyway, before we jump back over to, we've got 4 more questions saved in the dugout. I think I'll start calling it that, in the dugout. And I want to go get caught up in the chat here. So see what I missed here. So looks like I missed some conversation. Okay. Don't know what's going on, but let's see. Talking about some retirement or something or other. Yeah, Nino, I'll check Evo. I will check out Evo, but I've got a handful of other questions to get to first. I'm going in order, just based on the ones that are saved. Okay, Renzo, I'm glad that made sense. I'm glad that made sense. So yeah, we're gonna jump over to Matthew's question now. This is an interesting one. If you hit big on a 5% moonshot, 10x to 100x, 10 bagger to a 100 bagger, and then put that money into a dividend stock or ETF, is that better than investing in dividend stocks the whole time, regardless of taxes? Perhaps not. Right? Like if you would have generated more of a total return, obviously 100xing your money on that moonshot, then no, I would say that was probably a more favorable outcome than if you were to just have that sitting in something like Procter and Gamble the entire time, right? Which maybe, you probably would have made some money, but chances are you weren't going to 100x your money in Procter and Gamble during that time. So yeah, I would say, just hypothetically, it's better to 100x your money than not. So yeah, I think that answers the question right there. Regardless of taxes, though. So that's the thing. I mean, you'll have, you will have a tax implication from making that much money and making that much gains, but still, even after taxes, if it's a long-term capital gain, that's only going to be 20% of the gains going towards taxes. You'll still come out so far ahead if you 100x your money that it's not even like you'll be fine. So, but yeah, I would say it'd be great to be able to 100x your money. The big question is, and I guess that's the $1 million question, which stocks are going to get you that? And how long is it going to take? Is a bird in the hand worth 2 in the bush? And how long does it take for the 2 to come out of the bush? Those are that's the big question. That's the great unknown. So, but yeah, really good one. Thank you for asking. Oh yeah, Caesar, thanks. Amazing dummy 101 explanation of dividends. Thank you. Oh, Matt, great question about Meta and Google. I'm going to save that. We'll circle back to it. So real quick, Nino, just so you know, we've got one more question here from Trista, then we're getting to yours on Evo, okay? So Trista wants to know, can you explain why someone would invest in a REIT for the dividend, but doesn't outperform the S&P? Some REITs are even in the negative. Yeah, so this is a great question. And I don't want to, in answering it, I don't want to hone in specifically on REITs. I want to hone in on I want to hone in on individual stocks as a whole. Can you explain why you'd invest in something? Well, actually, yeah, man, this can be a tough question because there's a few different ways to answer it. So let me start by saying it really depends, I suppose. There's an argument to be made for not I think there's an argument to be made for not for being okay not outperforming the S&P. Let's say that you're someone in retirement, right? And you are using your passive income from your portfolio to pay your bills. I would imagine, I could be wrong. Let me know what you guys think in the chat here. I would imagine a person in that situation is not going to be as concerned about beating the market as they are concerned about just being able to pay their bills. And in that instance, I could see it being fine to just hold on to a nice, stable, cash flowing investment that may not be beating the S&P 500, but is still delivering solid, growing cash flow from dividends. You know what I'm saying? So I do think that would make sense. Um, and I know, and too, like when it comes to outperforming the S&P, I also think it's important to keep in mind, not just with REITs, but with individual companies and certain sectors of the market in general. You know, this is the stock market is a complex, dynamic system. It is always changing. There's always ebbs and flows, and it is constantly fluid. And there will be periods of time where certain stocks or certain sectors will outperform the S&P or underperform the S&P. And I think when you get to the root of all of this, what you need to do in your job as an investor, what you need to do is you need to, especially if you're investing in individual companies, you need to look at these companies and try and find the ones that are going to be, number one, that are ones that you understand. Number two, because you understand them, look for ones that you think are going to be able to generate long-term wealth. There will be periods of time where those will outperform the S&P 500. There will be periods of time where they will underperform the S&P 500. And I also think too, like at what point do you look at the investment and say, this isn't working, I'm better off in the S&P? Is it 1 year? Is it 5 years? Is it 10 years? Is it 20 years? Like how long do you wait? How long do you wait? And let's say that you're 10 years into it and it's underperformed the S&P by maybe 2%. Not per year, but like in general, maybe it's lagging by 2%. You look at that and say, this isn't working out, I need to be in the S&P, or do you stick with that individual investment, whichever it is? Like I said, this can be a very complex question to answer. Um, and I think at the end of the day too, there's more than one way to measure success besides just, did I beat the S&P 500, which once again can change over time. Some years you might beat it, some stretches of time you might beat it, some stretches of time you may not. It's constantly in flux. So I think it's a really tough question to answer, but I would say if you're dealing with a company like AG&C, I suppose is a good example. A lot of people invest in that company just for the dividend, for that 15%, 15.5% yield, which is going down over time. But a lot of people do that, and a lot of people invest in other companies just for the dividend. And I don't personally think that's the right way to go about it. Especially if you're someone who is not in retirement and is still, building up their collection of assets and building up their portfolio. Now, with that said, and that's kind of the reason why I decided to sell out of things like AT&T and Verizon, for example. I think those are, Verizon, I think that's going to be a steady dividend payer. And I think going back to what I started out by saying, I think someone in retirement, like there's an argument to be made that even though that's not outperforming the S&P 500, there's an argument to be made that, that can play an important role in an investor's portfolio, depending on the type of profile of that investor. You know what I'm saying? So it really, there's so much about that that's just, we need to chalk it up to, it depends. It depends. But if you have a losing investment, if on a total return basis, you're doing nothing but losing money with that company, then yeah, I think it's really worth giving it a close look and deciding whether or not it's actually a good investment. So a very roundabout answer. Hopefully that made sense, Trista. Thank you for the question. It made me think for sure. So yeah, hopefully that did something for you. Yeah, let me know what you guys think too about any of that. So great question from Chaparro. We'll get to that in just a couple of minutes. So we're going to go back to Nino. It's your time to shine, my friend. So we've got Evo. Wants to look at Evo. So let's see. Let's go back over to here. So EVO. No, that's not right. Am I even going to be able to EVVTY? Okay, let's check this out. Let's see if it'll work on here for us. Man. Okay, this needs to load. Maybe it'll take a minute. So first of all, what does this company even do? Oh, I've heard of this company. Live casino and slots to gaming operators primarily in Europe and the US. I have heard of this company. Okay. I bet you I've even played some of their games down on the strip. Let's see. So, this looks promising. I mean, it looks like it's on a relative basis, it looks like it's becoming better valued over time. In the trailing 12 months, PE ratio is only 15.5. Price to free cash flow is about the same. Free cash flow yield's not bad, almost 4. It's at its 52-week low. So I think that looks good. This is obviously very promising. So I really like that. Really like this. Oh man, this is looking great. Oh, dude, this is top. This is pure class right here. And they're a dividend payer. Oh my gosh, where has this been all my life? Oh my Lanta. Nice. Oh yeah. I'm kind of at a loss for words, actually. This looks beautiful. No debt too. I'm guys, I think this is the first time in my life I'm actually speechless. Yeah, this looks really good. Thank you for sharing this with me. I'm actually gonna add this to where's it based out of actually? Is it based out of Sweden? Okay. Let's take a look at their website just real quick. Huh. Yeah, I'm gonna add this to my watch list because this looks really good. Really stinking good. Put that there. Okay, we'll save that for later. Yeah, thank you for bringing this up because like that checks all the boxes. Growing revenue, growing from top to bottom, profits are growing, no debt, solid dividend growth, like very nice returns on invested capital. So yeah, that one seems to check all of the boxes. Yeah, looking good. Okay. So, okay, Mustafa, right here. What is your thoughts? We've got 3 more questions, guys, and we'll probably wrap it up for the night. So Mustafa says, what's your thought process on valuing stocks? Like, how do you say if a stock is undervalued? Can you take us quickly through your process? Yeah. So, valuation really is a tricky thing because there's so many different ways to do it. Everyone's got a different approach. Some people like to use the PE ratio or the price to free cash flow or dividend discount model or, you know, discounted cash flow. There's so many ways to do it. The longer that I do this, for better for worse, the more that I am partial to like the free cash flow yield. That's something like the free cash flow yield, or even like comparing just the 5-year average dividend yield. So like, for example, let's look at let's go look at a company like Rollins, okay? So hopefully it'll give us the stuff here. Yeah, there we go. So I might look at a company like Rollins and say, okay. And so real quick, just taking a step back, the free cash flow yield, this is something that I picked up from Terry Smith reading his book, Investing for Growth by Terry Smith. And his whole thing is he likes to, in his whole shtick is very simple 3-step process to investing. Buy good companies, don't overpay, do nothing. The second part, don't overpay, obviously has to do with valuation. And he looks at the free cash flow yield, and his rule of thumb and what he considers not overpaying is basically if you just buy a company when the free cash flow yield is at least, he wants to buy a company when the free cash flow yield is at least 1% above the expected rate of inflation. And right now, 10-year inflation rate. Right now, guys, let me see if I can find it. So right now, I think it's right here. I think it's this page. Right now, the 10-year expected rate of inflation is 2 points. Let's call it 2.12. So based on his rule of thumb, he would look to buy a company when the free cash flow yield is at 3.12% or above. Okay, so we could look at something like Rollins at a 2.46% free cash flow yield and say, probably not. It's probably a bit overvalued. And that's, compared to something like Clear Secure, which is the company that I just added to my portfolio a few weeks ago. Okay, even though it's gone up 116% in the last year, even with this, its free cash flow yield is still 14.6%. That's well over our mark, and that would more than suffice for Terry Smith. And so I think that's a really simple way to look at valuation. And like I said, people do it differently. Another thing that I like to do is I like to compare the dividend yield against the 5-year average yield. And the thing about dividend yields is especially because I think this is an okay thing to use because the dividend yield is in relation to the share price. And typically, if we look across time, dividend yields tend to hover in a certain range. Like in the case of Rollins, it's pretty steadily between 1.3 and 1.6% over these last 10 years. And in fact, if we look at the 10-year average yield, it is 1.31%. Okay, so I look at that and I say, okay, right now the current dividend yield, 1.3%, is about in line, or in the trailing 12 months, is about in line with the 10-year average yield. So based on its 10-year relative historical valuation based on this, it's probably about fair value. And I would want to buy something when the dividend yield is way above the 5-year average yield. And I think something that we can look at for that, let me think of an example here. So maybe something like, oh goodness, let's see here. Maybe something like a WP Carey, okay? So WP Carey's been on the down and out for sure. The dividend yield at 6.14% is about 7.7% above the company's 5-year average. That's not bad. We could probably think of a better example to use, though. Let's see. What about, I want to say Chevron, but let's see. I think we can come up with something better. Maybe KRC. Let's try KRC. Hopefully it'll load for us. So this is way better, right? So in the trailing 12 months, KRC's dividend yield at 6.07% is 53% higher than the 5-year average dividend yield. And furthermore, if we scroll down, it's considerably above, well, the 5 and 10 year are really not too far apart. So I would look at that and say, based on this right here, especially if I'm a dividend investor going for cash flow return, I'd love to buy things when I can get an above average cash flow return on them. And this certainly checks that box. Now, does that automatically mean you should go and buy the company just based on that one thing alone? No, not necessarily. And on the inverse of that, you shouldn't stay away from a company just because its dividend yield is right in line with the 5 or 10 year averages too. There's so much more that you have to look into and think about and consider, because certain companies, especially those that are higher quality, it's the opportunity to buy them at a discounted valuation is going to be pretty few and far between. It's not too many opportunities to be able to do something like that. Like probably the most recent time would have been like the pandemic or something like that, to buy something like Visa, for example, at a super, super deep discount. So, you also have to think too, like, is this company worth paying a little bit up for? Is it worth, if it's at a premium, is that worth it? And certain companies certainly can be. But there's a fine line to that as well. So you can look at something like Costco. Okay. This is the last example I'll use. Sorry for the tangent. Costco, undeniably a very high quality company. And I wouldn't trust these exactly, but right now this doesn't look exactly right. But free cash flow yield, it's a bit on the lower side. I actually thought it was lower than this. Thought the free cash flow yield for Costco was actually less than 1%. Let me see. Maybe I'm wrong. No, not quite. It's not too far off from what we had there on Snapstock, 1.86%. But anyway, there's still a fine line in paying up for quality companies too. So hopefully that made sense. Some of that made sense, at least. Okay. I think we've got like two more questions, and then we're going to wrap it up. So let's see. Jake, long story short, I'm not going to get too into Tractor Supply tonight. But I really like the company. I think it's a great company for sure. What did I miss here? Okay, so let's go over to this next question from Matt. This is a really good one. So do you think Meta and Google are going to raise their dividends and become great dividend growth stocks in the future? Payout ratios are super low and they're still growing double digits. I think both of these companies have all of the makings to be fantastic dividend growth stocks. And if you look at the financials, like it's pretty easy to see. We'll just look at one of them. It applies to both of them. Let's just look at Meta. Okay. So did pretty nice free cash flow yield too, 4.33%. So kind of interesting. It was even better though. 2022 was close to 6. So yeah, I mean, when it comes to dividend growth stocks, this is what you want to see. Like the only way for a company to be able to consistently pay and grow its dividend, especially at the level that some of these companies have been able to, in the double digits, sometimes upwards of even 20%. They have to be growing like this. Everything has to be straight up and to the right. They got to be growing their sales. They've got to be growing their earnings and their free cash flow. Meta's clearly doing that. Margins are very high and stable. Pretty minimal debt. It looks like less than $3 billion. That's not going to be a problem for them. They're probably got way more free cash flow than that. So yeah, I would be surprised if these companies did not raise their dividend. I'm pretty certain they'll raise them over 10% consistently, at least for the first few years. I would be surprised if they didn't raise them over 20% as well. So yeah, I think they both have all the makings to be really great dividend growth stocks. So great question. Thank you for asking. And this brings me to the last one that we have saved from Chaparro. It says, what are your recommendations for beginners? How much to invest? and what dividends to invest in. So as far as recommendations, the first thing I would say is do not, don't chase yield. Do not be tempted by stocks with super high dividends thinking that those are for some reason or another better investments. It's not the case. So my recommendation when it comes to looking at it, if you're investing in individual stocks or ETFs, look at a company's dividend, look at the dividend history. You want to see it growing over time. You want to see a company increasing their dividend payouts over time. Basically, you want to see the dividend history chart look something like this right here, okay? Where it's just growing and growing and growing. So that's one thing you'll definitely want to look for. Another recommendation that I have is as fast as you can, if you plan to invest in individual companies, as fast as you can, start learning how to read financial statements. Learn about the income statement, learn about the balance sheet, learn about the free cash flow as well. Learn what those are, learn what they mean for the company, learn how to read them. And, I'm just going to throw it out there. Snapstock makes all of that stuff. Once you do learn what that is, Snapstock makes it so easy to analyze those things. Okay. It's clearly very visual, and it's very easy to see if a company's growing, if its profit margins are looking good, if its debt situation is favorable, if its dividend stats look good, if the dividend is sustainable based on the payout ratios. Pretty much everything that you need to quickly gauge a company's financial standing is going to be right here. So I'm super stoked with how this platform is coming along. But that is one thing I would definitely recommend. Learn financial statements. And hold on one sec. This book right here, I'd highly recommend this to any investor. Right here, pick up a copy of this book. This is Warren Buffett in the Interpretation of Financial Statements. Everything that I just talked about when it comes to reading the financial statements, this book is a great place it'll get you started on the right foot. So I'd highly recommend picking up a copy of this. It's about $15 on Amazon. Well worth it, and this is one, like, each chapter is a page or 2 pages. And this is one that I flip through every day, just continue to, just go through it and keep everything fresh. So I'd recommend that. And Jake, don't listen to this. I think he's just trolling you right here. So do not do this. Stay away from those. But yeah, that would be the my only recommendations, I'd say. I think you asked something about how much to invest. I would say just start small, start with an amount that you feel comfortable with. And then as you get established, as you get your bearings and, feel good about what you're doing or feel better about what you're doing, you can always increase that from there. And I think you'll find that over time, you'll do that anyway. You'll naturally increase the contributions to your portfolio. But I say start small, just get your feet wet. And then once you feel comfortable, you can increase that from there as needed. So yeah, I thought you were trolling, Jake. Nice, man. That was funny. Trista, yeah. So I didn't see the dividend payment schedule, but it wouldn't surprise me considering it's a European company. And I'm glad you brought that up, because that's an important thing to keep in mind when it comes to companies outside of the United States. Typically, they have different dividend policies. And I would say that maybe they're a little bit more loosey-goosey with the dividend than we are here in the States. And you'll find that a lot of them pay either annual dividends or semi-annual dividends, as opposed to here in the States where it's pretty much always either quarterly or monthly, pretty much always quarterly. So yeah, I do think that's an important thing to keep in mind. I touched on this in my Wednesday video talking about L'Oreal, but it's the same thing with them. Same thing with LVMH. So all European companies, it's just a little bit different. And I would encourage you not to get too hung up on that either. I understand that we all like, cash flow as often as we can get it. But at the end of the day, it's really all the same. If a company's paying $5, well, let's just do this. If a company's paying $4 per year in dividends, it doesn't necessarily matter if that $4 is coming all at once with one payment per year, or if that $4 is coming, if you're getting $1 every single quarter. You know what I'm saying? And so I would encourage you not to get too hung up on the payment frequency. And this probably more than anything applies to monthly paying dividend stocks. There are a lot of investors out there who will buy or actually just think higher of a company or an ETF because it pays a monthly dividend. And like I was saying earlier in the stream, now we have ones that are paying weekly dividends. They're upping the ante because they know investors, they psychologically, that's going to be more favorable for you. And it's understandable, but just know, like, it doesn't really matter if a company, even Realty Income, if they put a lot of emphasis on paying a monthly dividend or a weekly dividend or whatever it is, it's just a marketing gimmick. It really is. I understand that it feels good to get a payment more frequently, but it doesn't, it really doesn't make a difference for your portfolio in the grand scheme of things. It's negligible. It doesn't make your compounding go faster. You can run the math looking at a dividend calculator like the marketbeat.com dividend calculator. All else being equal, just change the payment frequency from annual to monthly to quarterly to whatever. It's all the same, really. So anyway, Mustafa, yeah, I agree. This is one of the best as a starter to explain the financials. Yeah, one of the best books as a starter to explain financial statements. I agree. So guys, I think we're going to wrap it up here. 6:12, 12 minutes over. This was a fun one. We had some really, really fantastic questions, and I want to thank all of you guys for just hanging out this last hour and some change, and all of you guys who asked questions. Those are some really good ones. If you haven't done so already, guys, 143 of us in the stream. If you have the capacity to do so, don't do it if you're driving cross country, but if you're around and can, just hit the thumbs up button on the stream one time. Just give this video a like if you enjoyed it. It would really do it wonders, really be a big favor to yours truly. So I'd appreciate it. But with that, guys, that's all I got for you. Once again, thank you so much for tuning in and hanging out. Be sure to check out Sunday's video. I got my monthly dividend and dividend income video coming out. A pretty solid month of income. I'm excited to share it with you guys. But with that said, I hope you all have a fantastic weekend. Keep up the good work. Stay warm. Hopefully, I hope all of you guys have a great week next week. And yeah, I will see you in the next one. Stay out of trouble.